Welcome back to another explainer. Right now, we're looking at a massive, rapid shift in market sentiment. We're distilling all the recent data on market reversals and these huge tech breakouts directly from the source material. So on the very first trading day of August, a sudden wave of positive data just hit the market and boom, all four major indices saw substantial gains. Led by the Nasdaq, the S&P successfully broke right through its resistance, and honestly, it's sitting just a hair away from new all-time highs. So let's dive right in, shall we?
Here's our quick roadmap for today's explainer. We're going to start with macro forces in Forex, move into Palantir and software breakouts, check out the big tech resurgence, dive into the SpaceX and Tesla outlook, and then wrap it up with some key tech stocks to watch.
You know, there's a really famous saying in trading, 3 green candles change beliefs. And wow, are we seeing that play out literally in real time right now? A rapid succession of positive market days has just completely flipped investor sentiment upside down. It's taking stocks that everybody recently viewed as lagging and transforming them right back into the center of attention as all this capital just rushes back in.
All right, let's jump into our first section, macro forces and Forex.
Okay, let's unpack the mechanics behind the recent Forex interventions, because this is fascinating. For a really long time, the incredibly low interest rates of the Japanese yen created this massive incentive for heavy borrowing and short selling, the classic carry trade. All that capital just flirted into the US dollar, which obviously drove its value up rapidly. Well, to stop the bleeding, the Japanese Ministry of Finance finally stepped in last Friday. They punished the short sellers, basically forcing them to cover just to stabilize the yen's exchange rate.
Now, you might be wondering, why does this matter for US equities? Well, capping the US dollar surge is actually a massive bullish catalyst for our markets. A weaker US dollar environment basically supercharges the earnings of large American multinational tech companies. It's simple math, really. Their foreign revenues just become so much more valuable when they're converted back into dollars for reporting. It's a huge tailwind.
Backing up all this bullish sentiment is some surprisingly strong U.S. July ISM manufacturing data. I mean, the PMI accelerated to 55.6. That is its highest level since May of 2022. Production hit 58.5, and new orders reached 56.7. And notably, the employment index actually recovered to 52.8, officially crossing back into expansion territory. All this data points to an annualized real GDP growth track of around 2.8%. Now, the catch, well, while AI and defense spending are driving really strong demand, supply chain bottlenecks and extended lead times are keeping those inflation risks elevated.
So, how does this all translate to specific sectors? Let's move to Section 2, Palantir and software breakouts. Palantir just delivered an absolute monster of an earnings beat. I mean, wow. Adjusted earnings per share reached 41 cents, completely crushing the 34-cent estimate. And quarterly revenue? It hit $1.9 billion. That is a staggering 93% year-over-year growth. Plus, their adjusted operating margins bumped up to an incredibly impressive 62%.
Riding that massive wave of momentum, Palantir went ahead and raised its full-year revenue guidance to somewhere between $8.15 billion and $8.158 billion, easily clearing previous estimates. And hey, it doesn't stop there. Their adjusted free cash flow guidance was pushed up to an incredibly healthy range of $4.5 to $4.7 billion.
So where exactly is all this insane growth coming from? Well, while U.S. government revenue grew a very solid 90% to $809 million, their U.S. commercial revenue just went parabolic. It surged by 149% to reach $764 million. Successfully commercializing well beyond their traditional government contracts is Palantir's true growth engine right now. And that engine drove their post-earnings stock price up to $143, testing key resistance zones right in that $151 to $161 range.
Zooming out to the broader software space for a second, the IGV software ETF has successfully shattered its $95.10 resistance level, opening up at $96. As we see funds rotating slightly out of semiconductors and shifting into software, the technical target is now pointing upward toward $101. And that's supported really nicely by the 200-day moving average, which is forming right around that $94 to $95 range.
All right, let's transition over to the third section, the big tech resurgence.
Let's break down the technicals for the big tech giants right now. Amazon has rapidly broken into new highs, with long-term support noted at $224, looking at a 2026 midpoint target of $265. Then you have Microsoft. Their massive AI investments are finally reaching an operational break-even point. They're sitting between $440 and $462 for upper support and facing resistance right at $498. Over to Google. Its path is pretty clear for new highs, showing solid support between $330 and $340. Meanwhile, Meta is holding a very strong support line at $500, looking at some near-term resistance around $632.
Focusing in specifically on Meta for a moment, the upcoming fourth quarter is absolutely a critical turning point for them. Because Meta's AI monetization is moving just a bit slower than its peers, the market really expects management to prove they can control costs, either by reducing headcount or slowing down that capital expenditure growth. To see a true structural upward breakout, Meta really needs to clear that major $680 level. Moving right along to Section 4, the SpaceX and Tesla outlook. Looking at Tesla, the stock has essentially hit the ceiling of its current trading range, kind of bottlenecked between $315 and $368. It's facing some seriously heavy resistance at this upper bound right now. Honestly, it's going to need a fresh wave of macro or fundamental news to break out beyond that $368 mark. For SpaceX, the timeline is literally everything right now. While their August 7th earnings imply a massive volatility swing of plus or minus $20, the true test isn't actually earnings. It's in mid-August. That is the first major lockup expiration, which releases up to 20% of restricted shares. All eyes are on whether insiders are going to hold or sell, because that decision will ultimately set the tone for the subsequent rolling lockup releases, extending all the way into mid-December. Let's round things out with our final section, key tech stocks to watch. Checking in on a few other major players. AMD is priced around $485 right now and faces a massive implied earnings volatility of plus or minus $50. It absolutely requires a huge guidance raise to break through its $530 resistance. Netflix, well, it remains stuck in this sideways consolidation pattern, so it's definitely requiring some patience from investors. ISRG is trading at a sky-high forward PE while its growth estimates slow down, facing strong resistance between $370 and $405. And finally, NVIDIA. It really needs to punch through that $206 to $216 range to unlock some new upward momentum. Shifting our focus to the broader market for a second, the S&P 500 has successfully cleared the 7756 resistance level, confirming a brand new high trend. This breakout is incredibly important. Why? Because it helps lift broader market sentiment and significantly eases the downward selling pressure we've been seeing on the Nasdaq. We're also starting to see some early signs that sell-side analysts are gearing up to significantly raise their 2027 S&P 500 forward earnings per share guidance. And if we get that mass upward revision, the forward trading target could sprint rapidly toward the 8,500 level. That is huge. To add even more fuel to the fire, algorithmic CTA flows have officially flipped from selling to buying. The downside momentum has completely reversed. This is injecting roughly $23 billion in new buying power during this uptrend, and it's raising global downside sell triggers to the 7453 level. So the trend has fundamentally changed. As long as the S&P stays above that newly raised 7453 trigger level, the algorithms are aligned, and the immediate risk remains low, which leaves us with one massive, lingering question. With CTA momentum flipping and earnings on the rise, are we just witnessing a short squeeze right now, or is this the start of the next massive bull run?